Let's say I lost everything tomorrow and I had to rebuild my financial future from zero with the competitive advantage, though, of knowing what I know now after 20 years or more of value investing. I could buy just 3 ETFs and plan to retire with millions, and this is exactly how I do it. If you're new to investing or feel like you've been spinning your wheels trying to figure out what to buy, I get it. I used to feel the exact same way, and a lot of me now feels the same way. But what if I told you that building wealth doesn't have to be complicated? You need a simple plan and a few key tools to execute it. I'm going to explain why these 3 ETFs can help you retire with millions in a way that makes sense, whether you're a beginner or just need a reset and you're more advanced. So let's start with the basics. What is an ETF? Well, an ETF is an exchange-traded fund. It's a basket of stocks. When you buy one ETF, you're buying a small piece of many companies all at once. This gives you instant diversification and reduces your risk compared to betting on just one company. ETFs are also super low cost, easy to buy through your brokerage, and they update automatically in real time. Mutual funds, for example, you have to buy them at the end of the day. They reset their values at the end of the day. But with ETFs, you don't need to worry about which stocks to pick or when to sell. The fund takes care of all of that. And the best part is they tend to outperform those Harvard MBA managers that are wasting your money by actively managing mutual funds. This is why all the great investors like Warren Buffett recommend them. In fact, Buffett has even said that for the vast majority of people, the best thing you can do is put your money into a low-cost S&P 500 index. Now, a lot of people say, oh, that's hypocritical because he buys individual stocks. A couple responses to that. One, he's Warren fucking Buffett. You're not Warren Buffett. I'm not Warren Buffett. None of us are. With that said, there are some people, especially people in our community, who do pick individual stocks. And I do believe in picking individual stocks if you have the right process. But first, start out with low-cost ETFs to hit your financial goals. Second thing, Warren Buffett's been asked, what happens when you die? He said, well, I'm going to donate the vast majority of my money to charity. But the money that he leaves for his family, he said to them, put it in low-cost S&P 500 ETFs. That's it. No need to outsmart the market. Just match it, and you're going to beat 98% of those Harvard MBAs out there and all of your friends. In the short run, might be a little tough, but in the long run, you will crush it. Most investors that try to beat the market end up failing it. Now, that doesn't mean you shouldn't do that. But again, you have your set fund, and we'll get into retirement calculator shortly, but the money you need to go out there and retire, you should put in low-cost ETFs. Instead of trying to be a hero, just match the market. Over time, you're going to do better than well over 98% of investors, and that's why I love ETFs. They're simple, they're efficient, and they're backed by decades of data. All right, so now that we know what ETFs are, and why they matter, let me walk you through the 3 that I would use to build wealth from scratch. The first one is VOO. This is the S&P 500 Vanguard ETF. It gives you exposure to the 500 largest companies in the US. Household names like Apple, Microsoft, Google, Amazon, Nvidia, all those Mag 7 stocks. These are some of the largest and most resilient companies on the planet. Companies that drive innovation, they drive growth across industries. They're also boring companies that pay great dividends. When you own VOO, you're basically owning a slice of the US economy. At the time of this recording, shares of VOO are $567 per share. Now remember, if this is too much, there are places out there, there are different brokerages that allow you to buy fractional shares. But what's most impressive, guys, the expense ratio here is 0.03%. Not 3%, not 0.3%, 0.03. That means for every $10,000 you invest, you're only going to pay $3 a year in fees. Compare that to the average mutual fund, which charges 1% to 2%, or around $100 or $200 for every $10,000. And they underperform. I hope you see just from that why ETFs are so powerful for the long run. Guys, think about that. $3 fee per year versus $100 or $200. Over 30 years, that difference significantly adds up. Potentially hundreds of thousands, if not millions of dollars, depending on the money you're saving. Guys, this is why on this channel, if you're new to the channel, I speak all the time about fire your financial planner. I just got a message the other day from somebody on Instagram where he said, Paul, because of your videos about ETFs, I did fire my financial planner. And I was like, that is awesome news. Now, your financial planner is mostly a salesperson, and I'm okay with that. Salespeople deserve to make a living. But when it comes to your money, what are you paying for? When you go out and buy a Ferrari, you're paying for a luxury car. And it doesn't necessarily be Ferrari. Whatever you buy, if you go to a nice dinner every so often, what are you paying for? You're paying for a better experience. You're paying for more. But the history shows and data shows when you pay your financial planner, you're paying them for less. That makes no sense. Now, this VOO ETF is passively managed, meaning it just follows the S&P 500 index. There's no one trying to beat the market. And that's good because when people get involved and when they make emotional decisions, investing is one of the few places where more activity leads to less returns. The key is consistency and sitting on your hands. Start with dollar cost averaging. So what does that mean? What that means is the market is going to do this over time in value, but the price is going to do this. Okay? Now, dollar cost averaging is very simple. You just go and buy every single month, quarter, year, whatever week, doesn't matter. And over time, you're going to pay the average. Sometimes you're going to overpay, sometimes you're going to underpay, but over time, you're going to do the average. VOO will be the foundation of your portfolio if you choose to follow the S&P 500. Now, there are other ones to VOO like SPY and SPLG. Both of them are State Street Investments version of the S&P 500 ETF. SPY is trading around $617 a share with a higher expense ratio of 0.09%. SPLG is at $72 a share with the same expense ratio as VOO. Both are very similar to VOO. They're basically, you cannot tell the difference. It's a matter of preference there. The next ETF is one that's a little controversial because it's SCHD. It's the Charles Schwab High Dividend ETF. Now, SCHD invests in high quality companies that pay dividends. Basically, these are businesses that share the profits with investors. Think like Coca-Cola, Verizon, Texas Instruments. Companies that have been around a long time, make a lot of money, and they want to redistribute that money back to its shareholders. Some of the top holdings for SCHD are PepsiCo, Cisco Systems, Amgen, Coca-Cola. Solid dividend-paying giant that continue to grow while returning cash to shareholders. Right now, SCHD has a dividend yield of about 4%. That means for every $1,000 you invest, you get roughly $40 a year just in dividends, and that will grow over time. This fund also focuses on solid financials, companies with strong cash flow, because remember, you cannot pay a dividend unless you have good cash flow coming in, manageable debt, and a history of rewarding shareholders. Why is that important? Because when the market gets rocky, these types of companies tend to hold up better. SCHD brings some stability to your portfolio, and even better, if you're using some sort of tax-deferred account like an IRA or 401k, those dividends are tax-deferred. You don't have to pay taxes on them. And when you invest them, you keep buying more and more dividend shares with that. And that can make a big difference over time. And again, like the other SPY, VOO, their expense ratio is very low, 0.06%, $6 for every 10,000 invested. Again, much cheaper than the average mutual fund. And if you have 10,000 invested, you're going to collect $400 per year on today's numbers and pay out $6 per year in fees. So as these companies pay out their dividends with strong cash flow and manageable debt, they're doing this from a form of strength, a position of strength. That's important because when the market gets rocky, these types of companies tend to hold up better because people will flock to safety. SCHD brings stability to your portfolio. You're not chasing the high-flying tech stocks here. Why? Because high-flying tech stocks need a lot of cash to keep on growing, so they shouldn't pay a dividend. You're building a dependable income stream, and over time, when you finally decide to retire, it's the money you could use to live off of. So whether you're a beginner looking for income or a more experienced investor wanting to hedge volatility, SCHD could play a vital role in your portfolio. Now, guys, I have SCHD because it fits my goals of what I want in my portfolio. But you got to remember, I've got 1,000 apartments. I've got several businesses upstairs that are all growing in value and generating cash flow. So my portfolio isn't there to try to get huge returns. It's just build stable money so I can live off that. That is why SCHD is in my portfolio. Now, I always hear people say, I'm a dividend investor. Get that out of your head. What you need to focus on is, can I buy a good company? Dividends, in my opinion, are the last thing a company should do with its cash flow. They should be paying down debt, buying back cheap shares, or growing the company through reinvestment and making acquisitions intelligently before they pay a dividend. But people all get obsessed with dividends. Let me tell you why it's not good. One, they're tax inefficient. When you get that dividend, the company already paid taxes on that money. It's paid out to you, you're getting taxed again. That's why I laugh when people are saying, oh, dividends, all these rich people have dividends, they don't pay tax on them. Yes, they already paid tax on them. As an owner of the company, your company paid income taxes on the profit. So they made $1 billion. They paid income taxes of 30%, let's say. So they're down to $700 billion. If they paid all that $700 billion out to its investors, they'd pay another 30% on that, which would be another $210 billion. That would take you down to $490 million on the original billion. You're down to half the money. So I always laugh when people say, oh, it's low taxes. No, it's not. It's double taxation. Now, last but not least, this is the one that's interesting. QQQ. This is the NASDAQ 100 ETF. This is where you go for growth. QQQ is made up of the 100 largest non-financial companies in the NASDAQ, which means it's very tech-heavy. NVIDIA, Meta, Amazon, Microsoft, some of those most innovative high-growth companies in the world. They have Apple, Costco, Tesla. These companies are the backbone of innovation and digital infrastructure. And if you're betting on the future, QQQ gives you exposure to the best of it. The expense ratio for QQQ is a little bit higher. It's 0.2%, but still very cheap compared to other mutual funds. And in return, you're getting access to companies that can deliver high returns on capital. What does that mean? It means that when they have cash, they can reinvest that cash and get really high returns on it. So as an example, let's say there's company A and company B. Company A can get a 10% return on its cash. Company B can get 30% return. If company A invests $1 billion in the company, they'll get $100 million in extra income every year. Not bad. Company B does $1 billion. They get $300 million in extra income. And if they can keep doing this for a long time compared to this one, it's just a matter of time before this company is several magnitudes larger than company A, even starting with the same $1 billion in profit. It's very important to understand that companies with high returns on capital deserve a premium. That's why QQQ tends to sell for a higher valuation than other companies. The upside of that is when you pay a reasonable price for QQQ, you can generate a lot of profit. But the flip side is these companies tend to be high flyers and hype companies. So when things get rocky, it can fall very hard. That's why for me, I don't put a huge portion of my portfolio in it. In fact, I haven't started buying it yet. I'm going to use it strategically. But here's some good news. QQQ in 2000 during the tech bubble to the bottom of the tech bubble fell about 80%. But here's what's interesting. If you started buying QQQ at the peak in March of 2000, even at the peak, before it fell 80% to today, you still made about a 14 to 14.5% annualized return on your money. Just by buying it right there. That's incredible. And if you kept dollar cost average, that's the return. Now, at the bottom, you probably made 18, 19% returns. The key to all of these is buying at the right time and continue buying as you go. I don't think QQQ for me is a third of my portfolio. I think it's smaller, but that's what I'm comfortable with. So look at that. Investing at the peak before an 80% drop, if you stuck with it, you would have vastly outperformed the market. That's the power of staying invested and not timing the market. Take advantage of those downturns. Buying during tough times sets you up for incredible long-term growth. Now, what percentage should you put in each ETF? I don't know. It depends how old you are. If you're younger, maybe put a little bit more in QQQ because you can ride out those waves. I don't think people who are younger should have SCHD. Why? Because they're trying to grow their wealth, and SCHD versus QQQ, you want something that'll compound for a long time. And as you're younger, you're going to keep adding more and more money to your account, so you won't see the balance drop as much, so it might not be as emotionally hard to buy QQQ. But I do believe the S&P 500 is a great place to be if you believe in the long term of the US economy. So guys, I said earlier that getting an actively managed mutual fund can cost you money. Let's look at it this way. Let's first start and say you're 30 years old, you're going to retire at 65, you have 100,000. This is our retirement calculator. It not only helps you understand your path to retirement, but then after retirement, do you have enough to live the rest of your life? I assumed a 9.5% return buying a low-cost ETF. This is 9 or 10% is the average on the S&P, annualized average over long periods of time. I did 7% during retirement. You're going to save $10,000 a year, a bunch of assumptions. And guess what? You hit the analyze button. Yes, you have enough from retirement. You scroll down to age 65 and you have $6.6 million in retirement, starting from $100,000 in age 30 and adding $10,000 a year, and that grows a little bit. Okay, now let's say you invested in that actively managed mutual fund. So first off, they underperform. So let's take a percent off just for underperforming. So 9.5 became 8.5. Then they charge you that fee. Let's say it's 1%. You're down to 7.5% while you save, and during retirement, you're down to 5%. Now let's hit the analyze button. You went from having enough to retirement to needing to save $9,000 a year more, almost double. Before you were saving $10,000, now you need to save $19,000. And instead of $6.6 million in retirement, you have $4 million. That's crazy. It costs you $2.6 million in retirement. And before, you had enough to live to age 95. Now you're broke by age 83 with your same spending. That's crazy, guys. Let's include QQQ and some more high growth opportunities. I said before that it can outperform by 4 or 5% a year. Let's say you make it 20% of your portfolio. To figure out the math there, it's essentially 20% times 4%. So it's 20% of 4%. You're increasing your returns by 0.8%. Okay, so instead of 9.5%, I did 10.3%. I hit the analyze button, the generate button, and instead of 6.6 million in retirement, I now have 8.17 million in retirement. Just adding 20% of that portfolio, if QQQ can return 4% more per year, which is a lot, that is a huge amount. You're going to get a lot of volatility with that. It could lead to millions of dollars more. This is why it's so important to understand what you're buying and why you're buying it. So there's a great way to make extra income. We talk about this all the time, and I've been doing this for 5 years, and this is definitely something that I wish I'd been doing 20 or 25 years ago. You can do it on ETFs. You can do it on individual stocks. Whenever you choose to do it, there's a thing called covered calls and cash secured puts. It essentially allows you on covered calls to take the stocks that you own, the ETFs that you own, rent them out to other people in the short run, and generate income. Guys, you can generate 1, 2, 3, 4% more per year on that money. You saw how much a difference 2% did in your retirement. Imagine how much difference it makes if you add this to your portfolio. Let's do a quick look. Instead of 10.3%, let's add another 1.5%, 11.8%, and 9.5% in retirement. Guys, you see how we're compounding more and more? We're now at $12.1 million in retirement. We started at 6.6, we're now at 12.1. And when you pass away, you see this? Starting from $100,000 and $10,000 a year in savings, $127 million. Guys, it's just math. That's all I'm doing here is just giving you math. This happens over and over. We have so many community members who've absolutely killed it. We have community members who are generating thousands of dollars a month in extra income on their portfolio. Guys, it's not a free lunch. You got to be disciplined, but that's why we teach these things. So if you want to just get an idea of what's going on there, click below, free PDF download on our options strategy. It's something I do every single month in and month out. I've been doing it for 5 years, and I've had high success with it. It's something that I like to share with a lot of other people. And we're getting more and more users every day in our community showing how successful they've been with it. So if you've thought about buying these 3 ETFs, that's great. Wait until you see what's possible when you combine that with carefully picked individual stocks as well as options. So click the video on your screen right now, because the truth is, most investors never learn how to buy individual stocks the right way. They follow hype, they chase headlines, they miss the real opportunities because they're worried about looking stupid. But you're watching this and you've gotten this far because you want to learn and be better. Our full investing course changes all that. You're going to learn how to build a real foundation, how to value companies, spot opportunities, and buy with confidence. This is your edge. It's a skill that can lead to market-beating returns in the long run if you play it the right way. So don't just stop at ETFs. Don't leave money on the table. Click now and start learning how the pros build real wealth. Thank you for your time.